proves to be an interesting discussion, particularly because when was it, Doug? A couple of weeks ago with the Silicon Valley Bank, and then you started kind of peeling back the onion around not only the financial decisions that they were making, but how actually integrated into the supply chain from a funding standpoint those decisions actually were. So, you know, when you and I had begun this chat, it was well before, at least my naivete, I didn't foresee anything like that coming, but it was well before all of that happened. So it should be really interesting to talk about this subject with that as the backdrop. I think I'm looking forward to it.
I agree with you, Stephen. Absolutely. I think the complexity of the supply chain and how critical its tendrils go into not just an organization, but to a good functioning of an economy is quite remarkable.
You know, the thing about it too is it's always been that way, but it hasn't been spoken. And I think probably COVID was the thing that kind of revealed the importance, obviously, of the supply chain, broadly speaking. But to your point, I like that, the tendrils, how deeply it goes. So those are, yeah, for sure, topics that I'm looking forward to starting. So before we get going, I just want to go ahead and thank one of our sponsors. Then I'll hand it over to Doug to both introduce himself and also talk about his company on the back end. But want to thank the Florida Atlantic University Masters in Supply Chain Management program. So I happen to be fortunate enough to be the director of that program. We've got two separate branches. We've got one which is a full-time traditional program with courses that are 16 weeks, and these students will typically, you can finish in the course of a year. Alternatively, we've got an executive option where if you're a working professional, you can schedule your coursework on a 8-week, every course is 8 weeks. You typically do 2, maybe 3 courses, depending on how aggressive and ambitious you want to be, but you can have a fast track to about 18 months. So if anybody who's on the line is interested in that, please do feel free to reach out to me. But that's enough on my end. I always feel like Bob Barker, you know, I just don't have a cool microphone and telling you to get your pet spayed and neutered. But with that, I'll hand it over to Doug. Doug, would you mind just introducing yourself, please, and your company? That'd be great.
Absolutely, Stephen. Thank you. First of all, thank you for the honor of having me speak with you and the audience today. For the folks out there, my name is Doug Radke, and I'm a senior director at SGS Mainpoint. A quick brief about SGS Mainpoint. We aim to be the premier buy, make, move, fulfill supply chain consulting company for our clients. And those are typically publicly traded firms as well as private equity platform companies. I think along that line, since we've been rated the #1 supply chain consulting firm by Consulting.us, I think we're doing well towards those aspirations. Specifically, I've been involved in mergers and acquisitions and supply chain process transformation for approaching 3 decades. So I've not only had an academic approach to it from my background education, but also real world, both in industry and as a consultant.
That's fantastic. So you probably are the perfect person to talk about the topic for today, which is, I had to borrow a phrase from the 2008 financial crisis, not too big to fail, but too complex to fail. So the backdrop for everybody on the line that's listening, and ultimately those who hopefully will be listening via the clip, the backdrop here is that the modern economy is built off of supply chains implicitly. And so one of the things that when Doug and I started talking, we wanted really to frame was what exactly is the role of supply chains as it relates to the financial health of firms, financial health of the economy. So with that, Doug, can you kind of give us, based on your experience and everything you've done over the past 30 or so years, 20 or so years, can you frame exactly the importance of the supply chain and multiple supply chains to the financial health of firms and to the larger economy overall?
Sure, that's a great question, Stephen. And as I think about the supply chain and its strategic importance, and I use the strategic word intentionally, It's because it's more than just the buying, the cutting of POs, and the issuing releases against a master PO. A supply chain is strategic. Really, I frame it in three fundamental areas. First of all, it is a critical link to customer satisfaction. You think about a firm and their desire to please customers. The supply chain is implicitly involved in making sure the products or services and or the inputs into those meet and are able to support that customer satisfaction goal. Now, certainly important to the health of every firm is the financial impact. You're looking at most industries have over 50% of this expenditures in that cost of goods line item, and once you break it down. So clearly there's a financial impact, which I can talk about some examples later. And then finally, as you think about it, your choices in supply chain also drive your choices around your talent, who you employ in your company, and how many and what their level of expertise needs to be. And those are three elements that, if those aren't strategic to a firm, certainly can't imagine too many more dimensions.
No, that's true too. I think the interesting part is, obviously, when you think about it from a cost of goods sold standpoint, yeah, that's exactly what the supply chain is acquiring and transporting. But there's also an element to it with service-based firms too, right? There's the service supply chain and all the kind of indirect procurement that goes into it as well. So fulfillment, broadly speaking, I think if we can distill down what you just said, fulfillment is a critical customer service, which is also a critical, necessarily element of the financial health of firms. That's a really good point. So, oh yeah, go ahead.
No, I can say yes. I've got examples to your point about service firms, whether it's contract employees, whether it's tools that they need to do the job. A software as a service company had to procure outside coding services. So you're right, whether it's a manufacturer, a distributor, or some sort of service-based business, absolutely critical.
So when you're thinking about, obviously, each of the individual firms functioning well based on how well their supply chains are orchestrated, that leads up to an aggregate how well an economy is doing, because it's all interconnected, incredibly so. So when you pull back for a second, and in your role as it relates to doing due diligence, or maybe previously when you've done valuations or just the financial health, when you're looking at a firm's supply chain, can you talk a little bit about where that financial value is? So, is it in the assets? Are they leveraging it for cash flow? I mean, how are they leveraging the supply chain for cash flow and other financially driven metrics?
Sure, absolutely. And I'll break down my answer into a few components, but you're right there. The first one I'll discuss is your asset comment there too. So when you procure, whether it's raw materials, parts, or actually full components, there's an asset that not only sits in your balance sheet, but once you take ownership of it, it resides in one of your warehouses. Companies can borrow against, that type of can be used as a collateral. Not usually 100% of it, but absolutely the case to do that. You've got value in the assets if you're a manufacturer, in the assets you're using actually to produce those. There's also intrinsic value, if you can imagine this, in long-term agreements. If you've got you've got value in a long-term, if you've got a commodity buy that's a long-term play, but you only have possession of a small portion of it now, there is value, or there could be risk in those types of commitments long-term as well too. So there's just an aspect of that type of asset financial value that you talk about. The other value, which I think it's important to think about too, is that there's an implicit value that any company has based on how their supply chain is functioning now. And it's reflected in their cash flow for all of us, those of us who have a financial background, because your company's performing and generating X amount of cash flow based on how it goes to market now. Now, I believe this from my own personal experience, but MainPoint has proven since its founding that if you improve the maturity, so the process, the tools, and the capabilities of the team members within an organization, and you improve how a supply chain operates, there's more cash value, more financial value that can be unleashed from a company. Go back to our earlier comment about supply chains over half of the expenditures in a company. It's a large area to look at for potential value creation opportunity in any firm.
So when you're thinking about that and you're thinking about the areas of optimization, let's say for optimizing process in order to increase cash flow and things like that, there's also kind of an element to risk management, isn't there? Because there's a whole, yeah, I mean, because you talked about it a little bit, right? My question is kind of two parts, and you can address whichever you want, but however you want. But the way I'm thinking about it is, if previously it was kind of this non-strategic, purely tactical sort of get the materials where they need to be at the lowest cost possible, it wasn't thinking about it in terms of the strategic importance of it. Something like a futures contract or forward buying or, you know, hedging or anything, these typically financially driven tools wouldn't have been even thought about, but really they are strategic because it's risk management. I mean, can you talk a little bit about your experience on that?
Sure. And I'll provide a few examples, but to your point about this, and I would share that, again, this is both influenced by my professional experience, but also Main Point's philosophy. So first of all, I'll just give a quick backdrop. Main Point's approach towards supply chain is called total value optimization. And in that concept that we take to market is that your operations, your logistics, and your procurement have to work together in a cross-functional team-like function underscored by data analytics, data visibility, and people. So much like that, if you take it to a broader context, the supply chain is also an integral part of that overall organization, to where finance is not separate from supply chain, which is separate from risk management. They all have to be working as a synchronized unit. So to your question, in my experience, I have two examples, but I'll speak of one in particular. In the early 2000s, one of the largest fertilizer manufacturers in the United States was in a position relative to its natural gas buys. Natural gas is a critical ingredient for fertilizer production. And it actually had forward contracts that were very favorable. In the early 2000s, the price of natural gas went from $2.50 a therm up to, it spiked at over 14 that winter. Now, they were protected very well because of their forward contracts on the upside. And come springtime, when normal weather returned and a certain gas pipeline that had interruptions done, the gas prices started to fall. And they made a choice to go, and I'm just going to use broad numbers. They chose to purchase forward and fix their price at about $5 a therm. The market went on down to $2.50 again. So effectively, their cost of goods sold for production was twice of what the market was for that period of time. And it had damning financial effects on the firm.
So in that situation, was the contract structured so that they didn't have the option, they had the obligation to acquire at $5 a therm, right? They couldn't trade that contract if they wanted to because it was worthless, and then they necessarily had to acquire it at the end. So that was kind of an initially intelligent way to hedge against what were perceived to be inevitable price hikes, but ended up being the opposite happened because the market took a downturn, right?
The answer to your specific question, Stephen, that is absolutely the case. They went for effectively a take-or-pay contract as opposed to one that had optionality to it. And, certainly probably oversimplifies the complexity of a hedge portfolio, but they didn't understand what a true hedge was. And I think probably the other aspect of it is, which is why supply chain becomes so critical. So you're talking about a raw material. I mentioned natural gas. If you manufacture a product with price too high, you now have a finished good product that's locked in pricing that's too high, which, going back to my earlier strategic importance, affects the future value of a firm once those above market products get sold, sometimes even at a discount. So it's critical to have a true understanding of the market and the implications of the positions you're taking.
Well, so that comment and situation captures, I think, why we titled this conversation what we did. It's truly too complex, or not too complex, but it's exceptionally complex, because what you're describing, right? So if you have a scenario where for whatever reason, one way or another, through bad luck or poor decision making or a combination of both, you end up having raw materials 2x what the market would bear. And those raw materials, even if you thin out every possible ounce of waste in the downstream bit of that process, let's say you're left with a product whose price to you, whose cost of goods is 30% higher than what the market would bear for that product. Well, you've got a situation where you say, okay, do I take a loss? Do I dump it off in a different market? Do I write this off? I mean, do I donate it? So, but that complexity proves and demonstrates, and it's going to lead into my next question, I think, but you can comment on my observation. I think it proves the complexity isn't simply the way in which we're orchestrating sourcing arrangements or distribution arrangements. It's really the connection between those two and the role that pricing has on everything, right? And especially with currencies. I mean, have you dealt with firms who acquire materials in different currencies, and does that add another layer of complexity to everything?
Absolutely, Stephen. So the answer to the last part of your question, yes. Not all of our clients make purchases in US dollars. And so there is that interplay with whether they do financial, hedging in terms of currency risk. The other aspect of it is, and just to put some little twists, tariffs and duties. And you really want to look at your total landed cost when you're comparing your alternatives. So you're going to include transportation and any other of those fees that happen along the way, including those that I just mentioned and you mentioned as well too.
Yeah. So taking all that together, from your standpoint, when you're going in on the ground in order to do due diligence and evaluate kind of the financial health, what are some of the supply chain metrics and measurements or financial metrics? I mean, how are you doing your tests the way that a doctor would check a patient's vitals? How are you checking the supply chain's vitals? What are some tools that you're looking at or measurements that you're looking at to gauge?
Your questions are really pulling together what we think about when we go into an assessment phase too. So as you would expect, any company's decisions are never made in isolation. You have your external factors to think about. So certainly we do an assessment of the market implications, both geography in a country's and what an industry type dynamics are too. So you have to make those types of assessment. But when you're looking specifically at a company from the supply chain perspective, you want to look at what we'll call the externally provided factors. So your suppliers, and going back to my comments about geopolitical situations, et cetera, and your internal, how is your supply chain actually functioning? So if I can, I'll break down those real quick for you as well too. So you probably caught the hint of it with a lot of US manufacturing base relying on parts, components, and raw materials from overseas. You want to look at a geopolitical risk. I mean, I would expect most on this podcast are familiar or have heard the term nearshoring or reshoring. And that's because certain parts of the world manufacturing, because of some of the goings on in the political and the cultural, is impacting the supply chain. Let's talk about those other external factors that I talked about. How is your supply base doing, right? How is your choice of suppliers working? You think about lead time. How long is it taking once your procurement department issues a PO that you're going to actually see it inside your warehouses in the US so that you can ship it to customer, right? That lead time is critical. I'll give you a quick example on that just to put some clarity to it. At one point in time during the post-COVID supply chain, we had a client who had a planning cycle, as you might expect, of about a year. And their supply base was planning out 15 to 18 months, which absolutely put a monkey wrench in their home goods company that their planning cycle was shorter than they could actually get the product into their warehouses. So that lead time and understanding the health of your suppliers by that lead time becomes critical. A few other supplier-based ones that should resonate with everyone on the call. The quality, are you getting in, whether it's the product meeting specification or even the packaging, protecting the product to make sure it meets the, when it arrives here domestically, is the quality at a ratio that's not harmful to the overall supply chain process. And then, probably the third one we think about from a supplier perspective and kind of the key fundamentals, an acronym is OTIF, on time in full. Are you actually, aside from the lead time, are you getting it when you needed it? And was the whole order completed, or did you get a partial shipment late, et cetera? Those three metrics, amongst others, are some critical levers to understanding how well your supply base is doing. And then the last part of my commentary was the internal factors too. From a financial perspective, a lot of it's measured against PPV, what's your purchase price variance against what your forecast was. But we would throw out another one there is how much have you saved on savings initiatives versus what you forecast them to be. So take aside PPV, which is more on a per SKU basis, and look at it overall. If your procurement partner says we can save you $5 million this year, what's the baseline, and have you actually performed against that, and how you thought it would roll out? So it's the combination, the health of a firm. You want to look at both the internal and external factors.
Yeah, one of the connections that I've seen made recently, I don't know if this has popped up for you, always it's OTIF, right? I mean, it's the critical metric around customer service, but cash conversion cycles, people have been talking a lot about as it relates to how well the supply chain is leveraging payment terms, or being able to leverage payment terms to maintain cash flow internally. So if I get 60 days from my supplier or terms, do I have to actually pay in 60 days, or can we push it to 90, to have my supply base essentially fund my production and vice versa? So are you seeing anything like that in terms of cash management, or is it more the traditional measurements that you just framed?
Sure. No, that's a great one. I hadn't even put that one up there, but it is actually something that we at MainPoint think about and work with our clients on. First of all, the extension, like you said, just to generate additional breathing space in your working capital. Absolutely. I'll give you another hypothetical example though. We have clients that aren't aware that normal terms in an industry, this is made up, are 45 days, and they're paying in 30. So they're actually putting themselves at a competitive disadvantage unless they're getting some sort of discount against that early payment too. So we look at what's the norm, and then you have to look also at the health of the supplier too, and whether that's going to put them in financial jeopardy. I know that's a dimension that you didn't bring up in your specific comments, Stephen, but as you might expect, COVID just didn't affect the US economy. Global suppliers were heavily impacted financially when their employees couldn't work, et cetera, too. So there is definitely a balance that has to be sought about maximizing your own financial position, but making sure your critical suppliers aren't put at financial jeopardy as well. So that's a critical dimension to look at for sure.
Yeah, because it's like cutting off your nose to spite your face, right? If you manhandle your suppliers from a cash flow standpoint, sure, your cash flow and working capital is doing perfectly, but or better, but they don't have the capital to be able to produce the things that you need in order to generate the capital to even pay them back. So it's yeah, that's a really good point that isn't discussed, at least not a lot from what I've seen, is your financial health is critical, but the financial health of the supply base can also be kind of a harbinger of doom for you if not managed correctly. That's a really good point.
Yeah, I think the philosophy I would share with people is that supply chain should not be a zero-sum game with your suppliers. And that definition of win-win obviously has a band around which you can do that. But if you're looking for long-term suppliers and a healthy relationship, it needs to be a factor for you.
So, okay, so we kind of framed up the connection between supply chain management, financial health of firms, which leads to the economic health overall if it's performing correctly. We also kind of pivoted and talked about specifically what was it about, or what elements of the supply chain do or can firms use to extract cash and leverage cash and everything like that, particularly from a risk management standpoint. And then we pivoted into the metrics. But now what I want to talk a little bit about is the downside. So when firms in general don't treat their supply chains as the tools for financial success that they are, and you mentioned one example about that bankruptcy, but what are some other examples of poor supply chain management practices and the way in which that negatively influences the financial health of firms?
Okay, sure. So, and I can bring in a few different examples, and I'll bring in one that's a story that I'll put some perspective on from the media that year. So I'll start with that one. And this is actually from a well-managed firm. So if everyone remembers last year, probably June timeframe, both Walmart and Target made announcements that they had too much inventory and they were going to have to do some heavy discounting in order to clear the inventory and bring in product that people wanted. Specifically, they didn't think they had transitioned quick enough away from COVID type buying into what was new normal type buying. So pre-COVID 2019, Target's gross margin was 30%.
Wow.
2022, gross margin was 25%. Now I'm going to oversimplify and say, let's pretend that all of that had to do with product pricing and discounting, et cetera. That 5 percentage point move was worth $5.5 billion of extra cost of goods sold.
No, man.
And that's a well-run company. So there are implications, and we can go into some companies that are not well managed. I have seen companies that have 8 years of supply of a product when their goal was to turn it 2 to 3 times a year. We have seen companies who, lately, with the tightness of the labor market, have relationships with their, the temporary agencies that they use for, let's use distribution center labor. And they have a 33% turnover in that type of labor. So not that they do it bad, but they're not spread out broadly enough. They haven't done enough for onboarding, et cetera, too. So whether it be material, whether it be manual labor, whether it's critical labor, absolutely the examples would be to bookend it. There's best in class companies out here that sometimes get it wrong. And the ones that are bad and get it wrong, it's terminal. It can be terminal.
You bring up an interesting point that has been discussed one way or another in earnest, or at least with force since COVID, which is inventory. So initially, the problem with inventory was that we had pivoted away from stockpiling to any measurable degree, and we'd gone to 15-day, maybe 20-day safety stocks. Then when COVID hit, those safety stocks were obliterated, and then sources of supply were sought after all over the world. And it seems to me it's always been this pendulum between stocking up, thinning out, stocking up, thinning out. What's your read on whether or not firms are willing to invest? And obviously not if it's perishable, right? If it's something that's perishable, you can stock what you can stock. But you said a company has 8 years worth of inventory sitting somewhere. I hope that's not milk. But nevertheless, what's your read on how firms are managing inventory post-COVID? Are they thinking about it differently?
Sure, it's a great question, and I think it certainly resonates to the point where a whole firm has to work together as a synchronous system. And you're talking about inventory planning here right now too. We're definitely seeing movement away from the just-in-time. That the whole just-in-time concept. Absolutely get that efficiency that's sought, et cetera. I wouldn't say though, your comment about the pendulum, it's not been a, hey, let's double it. If I were to use best in class, what they're doing is that they're ensuring that their planning processes and especially their knowledge around the linkage between their supply plan and their demand plan are very up to date and linked, and that they're not just visited on a previously done infrequent basis, so once every few years, or we'll review it when there's a problem. There's actually a proactive approach to make sure mins and maxes are set correctly, and this is best in class activity, and their order quantities are aligned towards that, and there's the proper incentives and aligned to make sure that there's transparency to where the inventory levels are on a real-time basis, and also that there's mitigating plans if something is not correct, that they can move with agility, that speed to make a corrective course change.
So, well, that's a good thing that it's not, an immediate double. But then the other thing that comes to mind too is, from a holding cost standpoint, the cost of capital tends to drive up how much it costs to keep the inventory. So with this current interest rate climate, are any of your clients or any of the companies that you're doing any diligence on, are they seeing holding costs go up because of the cost of capital rising? Is that becoming a pressure?
Absolutely, you're seeing holding costs go up, and it's certainly a discussion consistently in the CFO offices I deal with. I'll add one more element to your comment, but it's going to speak to why. It's not just the interest rate going up that's got their attention of it. It's also affected the liquidity of loan availability in certain markets. So quite frankly, there's a very, very consciousness by CFOs to ensure that their credit lines are stable. I mean, you're talking about away from the topic of this conversation, but in these types of markets, when you see some of the failures that have gone on, there are certain industries where lenders have just abandoned because they see the risk too high. You're seeing that in consumer credit right now for sure.
Yeah. So when you were doing this same activity or these same activities back in the first financial, I shouldn't say first, we've had a number, most recent large financial crisis, 2008, are you seeing any parallels there? Is it, I mean, I know it's a whole different situation, but the way in which the creep on liquidity and interest rates and overall economic environments, are you seeing any parallels, or is this just a whole separate situation from your vantage point?
Right now, I'm not an economist, but I don't see it. I haven't seen it get to that parallel yet where it has me concerned. And I would just say this is that credit crisis hit, if you remember, it was preceded by a very, very rapid commodity price uptick. Yeah. And well, let's use the 2008 financial crisis. Rapid commodity price uptick. 29, the COVID was from a different perspective, but from a financial crisis perspective, this one has some differences to it, but I absolutely see the lessons from them. There's always minor lessons along the way that would be well to be advised. A lot of people have short memory, but this is kind of the third cycle that I've seen in my professional career like this. And it's, better tools now to predict it and adjust for it. But that being said, not that everyone's aware of it or thinks about it consistently enough to make sure that they're going to prevent themselves from having risk relative to what could happen.
Yeah, and the reason why I bring it up, because it always strikes me as interesting the way that there's some type of systematic issue that ends up happening, and then there's a correction that's made in order to shore up whatever the issue was which preceded said calamity. And then ultimately there's an unintended consequence that manifests from the way in which it was shored up. So, in some ways, the two crises are absolutely distinct from one another, but in other ways, I think the commonality is the way that people are responding, which is probably why, going back to what we said originally about just that one Silicon Valley Bank example, the FDIC came in and said, no, we've got you. We're going to go above and beyond the $250,000 individual depositor limit just to instill confidence, because a run on the bank is the last thing a bank needs, especially one like that, that bank, which is funding ventures and potentially supply chain companies and things like that. So that interconnectedness to me has always been fascinating. Okay, so
Stephen, I think to the point that you raised, you're going to hear a term, or the folks on this podcast are going to hear a term more often. We don't need to talk about it today, but certainly I would just say this. When you start hearing the term resiliency in your supply chain, you're talking about that ability to pivot when there's externalities that happen. And yes, you may not be as able to predict those second and third tier effects, but not having a rigid approach to your supply chain, or being too rigid, I should say, relative to the circumstances, allows you the best ability to be that long-term venture that your corporation or firm wants to be.
So I have one related, I think, kind of last question. And by the way, for everybody who's on the call, if you do have any questions that you'd like us to bring up, please go ahead and pop those in the chat. And in about 5 or so minutes, Doug and I can, well, not me, I don't know anything. I'll ask Doug the questions. He can respond to the questions. But so one of the things that I've been thinking about as we've been chatting, and when you brought up resiliency, it really made me think about it. It's kind of the difference between good risk and bad risk. And I imagine, obviously, from a corporate finance standpoint, risk is risk, and the expected payoff for that risk is what really ends up mattering. But when you think about it from a supply chain standpoint, is investment in nearshoring, despite an increased cost, worth the risk of that expense, given the lower logistics complexity and ultimate landed cost? Or are these type of conversations being had, where are we willing to overspend in some sense from a risk standpoint? Are these conversations being talked about?
Absolutely. And specifically, I was in a call 2.5, 3 weeks ago with a private equity client. And private equity firms are very keen on the financial return. So a business case and with a solid ROI is always important to them. But they were cognitive if they nearshored and it was a break even or slightly more expensive alternative, they wanted to make sure of that. And that goes back to my comment earlier when you asked about what type of metrics we look at. Think about geographic concentration right now. And if you had 100% of your supply in a country that is currently under conflict, or there's a threat of geopolitical conflict, if you had that side of concentration, your board of directors or your private equity owner should be looking at you and saying, you have to have an alternative, or at least some portion of your supply base. So yes, we're helping clients do that because their perception is that it takes longer to affect than it really does. But also it should be done in a fashion very strategically on which products are moved, which capabilities you look for, et cetera. So we're not advocating doing it for a bad business case, but we're saying it's happening for a business case that doesn't necessarily have financial return as its highest priority of the investment itself.
Penny wise and pound foolish sort of conversation, right? The financial return is critical, but doing something that would be less expensive, that would cost you more in the long run, not necessarily the best move, especially with things like quality or even reductions into customer service and fulfillment. So that makes perfect sense. All right. So I think we do have a couple questions in the chat. Let me go ahead and grab those. Okay, let's see here. All right, to the first question, Charles wants to know, what percentage, so as it relates to mapping upstream supply chain all the way to the downstream in terms of financial performance, what's the direct contribution? So what percentage of contribution does the supply chain have to the overall financial performance of the firm relative to some other factors? What's the direct impact, I think would be the question.
Sure, and without trying to be too obscure in my comment, it certainly depends on the industry. I mean, you're talking some industries like a distributor, their returns are in the 5% range when you get to the net income line. So you're talking about a huge portion of it that's tied up in costs of finished product, et cetera, too. And I'm talking the landed cost. here to that. In service business like software, it's a much smaller proportion, but it's because there's higher risk on the long-term growth, et cetera, too. So it really depends. But Carl's question does bring up that other element, that understanding your supply chain is sometimes, depending on the industry, not just your suppliers, but understanding your supplier's supplier. And so those risks or those costs can be absolutely critical upstream from your supplier as well too. I mean, here, and I'll use the easy example of what you've heard enough in the media is about EV vehicles, electric vehicles. And the supply chain is not just the battery manufacturer, but the raw materials that go, the critical rare earths that go into the EV batteries. So that whole market is affecting what your cost profile is on down the chain, even into the final product. So,
yeah, for sure. Okay, so the next question comes from Tan May. Actually, two questions. So the first is, how do companies like MainPoint, how are they reacting to geopolitical risk, number one? And then number two, on compliance risk as it relates to different continents and sustainability. So on the one hand, geopolitical risk, and on the other hand, how are compliance and sustainability being planned out?
Sure, and I'll speak to the first one because I'll be honest with you. We have a whole SGS is one of the largest testing, if not the largest testing firm in the world, and they've got sustainability and those types of audit functions within them. But in terms of your comments about the low-cost countries, I think the better term is best cost country. And whether it's nearshoring or whether it's to a different company, you've seen, and I'll use the clothing industry too. And the clothing industry is not just in China. You're seeing a lot of work in Vietnam, Pakistan, et cetera, too. So you might look at movement between countries that are in Asia and Australasia for that matter. There's options in the Middle East, quite frankly, in those industries, et cetera, too. And then there's the cost of, whether or not they're lower cost comparatively. Why did manufacturing in some industries move away from China? Because as they started to grow a middle class, their cost of labor has increased. So that assessment around where to do it is going back to those quality factors, cost factors, deliverability factors, et cetera. And you factor in that geopolitical risk of what is brewing that could affect that deliverability and that cost. So it needs to be done before any change is made to your supply base, but it should also be done as you think about your future supply base. So you're not just making a last minute hasty decision because you've not been, finger on the pulse of where your supply chain is at.
That kind of leads into the next question. Charles came back with another question saying, when customers fail to get products on time, blame typically goes to procurement as opposed to kind of spreading it out where it belongs, which is probably across multiple departments. How do you think responsibility is being shared across the supply chain? I mean, have dynamics shifted recently, or is it still being blamed on fulfillment or procurement or whatever they call it?
Well, there's definitely the cliches that supply chain and procurement get blamed for everything, but all problems are not supply chain based, and the answer is that it impacts your business development side. Especially if they're commission driven, not having product. There is a rational amount of having a little bit too much product to make sure it's available for sale too. I was joking with one of the faculty members at FAU at a function, and I've been taking pictures of store shelves since the beginning of COVID when I see an empty shelf or an empty block of shelves too. And yes, procurement might not be able to buy that product, and whether it's toothpaste or whatever it might be. But if the manufacturer can't produce it, then yeah, procurement might get the transactional blame for it. But the answer is, if you can't procure it at a price that can be sold, it's better off for the financial interest of the firm not to do it. So
Yeah, the downside risk is a lot lower for not buying relative to overbuying and not selling, right? For sure.
exactly, or buying at too high a price that can't be paid. Absolutely, 100%.
All right, Charles is going to be the MVP of questions today. He's got another one. Wants to know, have supply chain, or rather have firms woken up from the COVID implications, and are we likely to see shortening of supply chains, offshoring and friend sourcing and things like that? So you're going to see a contraction, or are you seeing supply chains in their length decreasing?
In terms of the effort to decrease them, absolutely. Multiple projects this year that I've worked on in myself that are for that very goal. As I used that term earlier, best cost sourcing, it sometimes can be a two-pronged strategy where you move it to an alternative country, a portion of it that's still in that Asia low-cost portion of the world, with a term to develop your nearshoring over the next year to 2 years. But absolutely, there's been an effort to do that. I mean, that's on top of the fact that supply chains have been getting shorter anyways, because a lot of the constraints are starting to exit the system. Still, even with that relief, the consciousness of what can happen to the supply chain is definitely pushing that movement. Probably the last element of it is that the government, through its tariffs and duties and other incentives, is motivating companies to consciously make that move, even if they wouldn't have on their own. So going back to your comment, Stephen, about externalities, government action will drive that type of behavior as well too, or at least should.
Yeah, it'll manipulate it one way or the other.
I'll call it a nudge. Sometimes the nudge is a little bit stronger than not.
There you go. That's a very political way to put it. I like it. Good. Well, it looks like there are no more questions. Oh, I lied. There's one more question, and this will probably be the last one. Ken wants to know, as a supply chain consultant, what are the most important skills which are required in today's era? What do you think? What's the most critical?
Oh, that's a great question. That's an excellent question. So first of all, I would say, and I'm dating my generation when I say this, is an appreciation for the power of information and the power of large data sets. Really, and that's, I came up through the financial planning and analysis part of the corporate world, so I was familiar with that. But now big data is now involved in supply chain and understanding pricing, SKUs, where sales, margins, et cetera, too. So having an appreciation, even if you don't have the skill set, understanding how much insight is available within the data is critical. And so you have to have an appreciation for that, whichever part of the supply chain that you're in. The second aspect of it and it's more of a soft skill. I'm going to call it supplier relationship management. I share that concept early in our discussion, Stephen, about being win-win with your suppliers. Don't take win-win as that everyone's happy all the time or that everyone gets exactly what they want, but actually having honest and solid dialogue and that ability with your supply base and with prospective suppliers and understanding what their needs are and what your company's needs are. It's much more of I'll say it's not collaborative, but it's much more symbiotic in how you have to interact and communicate. And I think this generation of supply chain folks are much more geared towards it. It's not necessarily always the combative beat them down on price, but it's really articulating what your needs are and working with your supply base or new suppliers to deliver on those needs that your company has. To my comment, on time and full, quality, carrying inventory, order, those require dialogue and good interaction on a much more consistent basis I could oversimplify and call it communication, but it's really a supplier relationship management plan that works for both sides.
There's that balance between IQ and EQ, right? IQ plans the world, EQ runs the world sort of breakdown, you know?
Yeah, I'm probably the last aspect, and it's a great question. And it kind of goes to that, going back to your comments about question about what do you look at when you do an assessment. It's also trying to take as much of a zero-based look when you do that assessment, meaning try to put aside as many of the biases that you may have, which is why firms bring in an outside consultant like MainPoint all the time. It's look at us critically with that, hey, what can we improve on? Because very, very rarely is it a clean wipe of the whiteboard, right, and restarting. But there are usually areas that are fundamental to value creation or risk mitigation, and it's looking at that with an unbiased view and not just waiting till a critical moment to have that done. So that would be the last aspect of it is going into a very open-minded to hear new ideas and new ways of delivering on the supply chain goals.
Well, I think we've come to the end. So obviously, thank you so much, Doug. This has been phenomenal. Just a brief word to thank our sponsors. Thank you to the Masters in Supply Chain Management program here at FAU. Again, I have the privilege of directing that program. So we've got two different tracks, one traditional, one executive. It encompasses exactly what Doug just said. There's information and coursework on big data analytics and processing big data, handling big data, but also on negotiating and procurement and purchasing. So all plan, source, make, deliver elements are covered. If anybody is interested, I'm happy to engage in that conversation. Doug, I want to thank you again very much. And of course, MainPoint for allowing you to speak with us today. And if you'd like to say anything, now would be the time, but thanks very much. I really appreciate it.
Stephen, I'm honored. I appreciate FAU's presence and efforts like this in our community. It's awesome for South Florida, and thank you for all of those who listened in today, and especially those who submitted questions. It certainly added a dimension from the pre-planned thoughts we had. So it's been great, and Stephen, I very much appreciate it.
Absolutely. Well, thanks again, everybody that joined, and we will speak with you soon. Take care.
All right. Take care.
Bye.